Hi everyone, I'm Dr. Soundararaj. I'm very happy to interact with you all through this video. In this video, I'm going to deliver a lecture on the topic Discounted Payback Period Method. These are all a couple of details related to my career. After you watch the full video, if you find the video beneficial to you, give a like to the video and do subscribe my channel and enable the notification button as well so that you will get the notifications of my future videos. Discounted payback period is one of the improvements in traditional approach to payback period. In this video, I will be explaining the three improvements that are taken place in traditional approach to payback period. What are all the improvements taken place to the traditional payback period? 1. Post-payback profitability. 2. Discounted payback period. And 3. Payback reciprocal. We will be discussing in detail of all the three improvements that are taken place to traditional approach to payback period. One of the most commonly used techniques for evaluating capital investment proposal is cash payback or payback period method. It's mainly because of its simplicity. It's very easy for people to understand and also to use without consuming much of the time. Some authorities on accountancy, in order to make up deficiencies of the payback period method, evolved new concepts. As I said, there are three improvements taken place to the traditional approach of payback period method. Let's get into the details of the first one. Post-payback profitability. One of the limitations of payback period method is it neglects the profitability of the investment beyond its payback period. Once the payback period is calculated, the profitability of the project after the payback period is completely ignored by the traditional approach of payback period method. This method is known as surplus life over payback period. According to this method, the project which gives the greatest post-payback period profits may be accepted. It has been explained in the following example. Post-payback profitability is calculated with the formula of annual cash inflow into the estimated life minus payback period. That means post-payback period into annual cash inflow will let us know the post-payback profitability. This is point number 1. And the next one presented here is post-payback profitability index. This could be calculated with the formula of post-payback profitability or profit divided by investment on the project into 100 will give us post-payback profitability index. We will be calculating both in the illustration given. A concern is considering two projects X and Y. Following are the particulars in respect of them. The projects are named Project X and Project Y. The cost of Project X is 1,40,000. And the cost of project Y is also 1,40,000. Economic life in years for X 10 years, for Y it is 10 years. Estimated scrap value for X it is 10,000, for Y it is 14,000. Annual savings of X it is 25,000, it is 20,000 of project Y. Ignore income tax. Recommend the best of these projects using A. Payback period, B. Post-payback profit, and C. Index of post-payback profit. So based on the results of all these three methods, we have to recommend the most profitable project among the two projects available in front of this concern. Now let's look into the calculations done here. Cost for project X 1,40,000, for project Y 1,40,000. Savings for X 25,000, savings for Y it is 20,000. This is the annual savings. Now payback period is calculated. How this 5.6 years for project X is calculated? Since the cash inflow, which is nothing but annual saving here, is uniform, let us do the calculation like this. In the first year they would have recovered 25,000. Second year another 25,000. So likewise, in first 4 years they would have recovered 1 lakh rupees. And the fifth year they would have recovered another 25,000. So totally till the end of 5 years, project X would have given us back 1,25,000 rupees. Now, what is the balance to be recovered to get back the total investment on the project? The total investment is 1,40,000. Till the end of 5 years, we have recovered 1,25,000. Therefore, we need to recover 15 more thousand rupees through the cash inflow of the 6th year. So therefore, we depend upon the cash inflow of the 6th year to recover the balance of 15,000 rupees of our investment. Now, let us calculate payback period for project X. 5 years plus 1,40,000 minus the amount we have recovered already till the end of 5 years, that is 1,25,000, the whole divided by what is the cash inflow for the 6th year. For all years it is only 25,000 rupees per annum. So divided by 25,000, we will get the answer of 5.6 years as payback period for project X. For project Y, the investment is 1,40,000. The savings per annum is 20,000 rupees. So 7 years into 20,000, we can exactly recover the total investment made on project Y in 7 years time. So 7 years is payback period for project Y. Now economic life for both the projects given in the problem is 10 years, 10 years. Now let us look at the surplus life. The total life of project X is 10 years, whereas you find 5.6 years is its payback period. Therefore, 10 years minus payback period 5.6 years, the balance of the life of project X, which is nothing but 4.4 years, is a surplus life. So, life over payback period is the surplus life. Now here, the life is 10 years for project Y. Payback period is 7 years. So 10 years minus 7 years, it gives us 3 years as the surplus life for project Y. Now let's get into the calculation of post payback profit. Item 2 stands for savings per annum, 25,000. Item 5 stands for surplus life of the project. So 25,000 into 4.4 years, it gives us 1,10,000 rupees. That's a post payback profit for project X. For project Y, item 2, it is nothing but annual savings of the project, 20,000 rupees. Surplus life according to the character 5 is 3 years. So 20,000 into 3 years, it gives us 60,000 rupees as post payback profit of project Y. Now let's calculate index of post payback profit. 1,10,000 post payback profit divided by the total investment on the project, 1,40,000 into 100, it gives us 78.6% as index of post payback profit of project X. Project Y, post payback profit 60,000 divided by total investment on the project, 1,40,000 into 100, it gives us 42.9% as the index of post payback profit of project Y. Now looking at all the three details collectively, we can find the post payback profit and the index of post payback profit of project X is much better than that of project Y. Therefore, let us conclude saying that project X is the best one by all the methods of ranking. If you consider only the traditional method of payback period, definitely you will prefer only project Y. The reason, project Y has got shorter payback period of 3 years comparing than that of project X, which has got 4.4 years. But looking at the overall results of all the three, we have come to a conclusion that project X is more profitable or the best project to be preferred than project Y. Now the second improvement to traditional payback period method, discounted payback period method. One of the limitations of payback period method is that it ignores time value of money. It doesn't consider the present value of the future cash inflows in its calculation. To overcome that limitation, discounted payback period has been introduced. So let us get into the problem given here, using which discounted payback period is calculated. Cost of the project 50,000 rupees. Operating savings for the 5 years are presented here. So the lifetime of the project is 5 years. And the cash inflow or operating savings of the project are not uniform for all the 5 years of the project. Fine. Calculate payback period ignoring interest factor. This is a traditional method. And B, discount payback period taking into account the interest factor at 10%. So the discounting rate in the problem for this project is 10%. The 10% discount rate is normally calculated based on the industry to which this particular concern which takes up the project belongs to, nature of the project, the risk involved in the project, and the ability of the concern to get a kind of return on its investments. So keeping in mind all these aspects, they determine the discount rate for the concern. It could vary from concern to concern. So it is 10% that is suggested here. Payback period is calculated in a traditional way. Annual savings for 3 years are presented here. Why it is enough to calculate payback period with the help of the cash inflow for the first 3 years itself. That is why it is done with only the first 3 years. First year 5,000, second year 20,000. So 5 plus 20,000, it becomes 25,000. Then third year 30,000 rupees cash inflow. So 25,000 plus 30,000, it comes to 55,000. Till the end of 3 years, the cumulative savings or cumulative cash inflow comes to 55,000 rupees. Now look at the investment made in the project. It is only 50,000. Therefore, payback period is not really 3 years, it should be less than 3 years. Because till the end of second year, we are able to recover 25,000. So we depend upon the cash inflow of the third year, 30,000 rupees, just to recover the balance of 25,000 rupees to get back our total investment of 50,000 rupees. Therefore, let's calculate payback period in the traditional method. 2 years. In 2 years, we can recover 25,000 rupees. Plus, what is the balance to be recovered? It comes to 25,000. How I say the balance to be recovered is 25,000. 50,000 is the cost of the project. Minus 25,000 which has been already recovered till the end of second year. Therefore, the balance 25,000 we are going to recover through the cash inflow of the third year. What is the cash inflow of the third year? It becomes the denominator. So cost of the project minus cash inflow recovered till the end of 2 years divided by the cash inflow of the third year into 12. We can say, if you want to calculate it in years and months, you can apply into 12. So therefore, what is the understanding here? To earn 30,000 rupees in the third year, the concern has to wait for the full year of 12 months. Therefore, the balance what we want to recover to get back our entire investment 25,000, how many months we need to wait in the third year to recover this 25,000? That's a question. So 25,000 divided by 30,000 into 12, it gives us 10 months. So 2 years plus 10 months is a payback period for this project as per traditional payback period method. Now let's get into the calculation as per discounted payback period at the interest factor of 10%. We need to refer a table named present value interest factor table. When the cash inflows from the project is not uniform in its lifetime, if it varies year after year, like the one what we find here, the first year it is 5,000, second year it is 20,000, third year it is 30,000, fourth year it is 50,000. It goes like that. Fifth year is not considered here because we are able to reach the stage at which we could recover the entire capital outlay of the project, and that is why they have ignored fifth year. Don't get confused with that because the data given in the problem is for 5 years. But over here they have presented information only for 4 years. We can write for fifth year also, no issue at all. But the job comes to an end even before we reach the end of fourth year itself. You will understand what I explained. Now, by referring PVIF table at 10% interest factor for period 1, the PVIF value for rupee 1 is 0.9091. For period 2, it is 0.8265. For period 3, it is 0.7513. For period 4, it is 0.6830. The simple understanding of this present value factor is nothing but the value of 0.901 is going to be rupee 1 after 1 year at the interest rate of 10%. What is the meaning? Today's value of 0.9091 is going to become rupee 1 after the period 1. I don't want to really call it as year 1. In this problem it is year, but if you refer the table, they mention it as only period. You understand, right? So always you look at it as a period. That is what right. In the problem, 1 period is equal to 1 year. In some other problems, 1 period could also be equal to 6 months. So it depends. Therefore, be very clear with what you learn. So at the end of 1 period, today's 0.901 will become 1 rupee at the interest rate of 10%. And similarly, today's 0.8265 will become rupee 1 after the end of period 2 at the interest rate of 10%. And similarly, you can understand the other aspect also. You understand, right? Now let us multiply the cash inflow of every year with the corresponding PVIF value. You get 4,546 for first year. This is the discounted cash inflow for first year. For second year, it is 16,530. For third year, it is 22,539. For fourth year, it becomes 20,490. Go for cumulative discounted savings. 4,546 is written as it is here, and add the 4,546 with the 16,530, it becomes 21,076. That's a discounted cumulative cash inflow till the end of second year. Now till the end of third year, the cumulative cash inflow at the discounted value comes to 43,615. What is the total investment made in the project? That means what is the present value of investment done on the project? It is 50,000. Till the end of 3 years, the company will be able to recover 43,615. Therefore, it will depend upon the fourth year discounted cash inflow of 20,490 to recover the balance of total investment. The total investment is 50,000. The amount recovered till the end of third year, it comes to 43,615. The difference between the two is 6,385 rupees divided by 20,490. What is this? This is a cash inflow of the fourth year. We depend upon to recover the balance of our investment, which we calculated as 6,385 rupees into 12. You put the 3 years in which we will be able to recover 43,615 rupees first. So 3 years and 4 months will be the discounted payback period for this project. Now the third improvement to the traditional payback period method is payback reciprocal. Sometimes payback reciprocal method is employed to estimate the internal rate of return generated by the project. Perhaps this particular calculation is used in computing IRR, internal rate of return, to determine the factor to be located in the present value tables. So we will discuss in detail of this aspect when we go for discussing the topic internal rate of return. Fine. Payback period reciprocal is equal to annual cash inflow of a project divided by total investment. It will give us a factor to be located based on which we can very easily calculate the internal rate of return of a project. What is really internal rate of return? It is a rate at which the present value of cash inflows of a project will be equal to present value of cash outflows of the project. That is what IRR. This is the simplest definition I can very well give for IRR. However, this method of ranking investment proposal should be used only when annual savings are even for the entire period. And number two, the economic life of the project is at least twice of the payback period. These two conditions are to be met out to apply the payback reciprocal. I hope I have done my lecture up to your level of satisfaction. I'll meet you in another video. Thanks for watching this video, everybody. Bye for now, all of you.